Hi everyone, Steve Lentz here with the Inside Wire. Welcome. Here at Discover Options, it is April 10th, 2018. Presented material is for educational purposes only. Should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Welcome everyone. We have a follow-up, perhaps one of a couple follow-ups to our presentation last week on revising the statistical edge analysis approach that we started out with a couple years ago. Actually, we started really exploring ways to just obtain edges in the market, and one of the ways we did that back then is that we looked at price from the perspective of price distribution bands, and whether those bands were struck more often than not when certain market conditions existed. Okay, so we would take a market condition and just look and see what the price distribution was versus the price distribution randomly over the course of several years going back to January of 2000. And so this approach wasn't really connecting. I don't think it connected well, and probably really it's difficult, I think, for it to connect with the average trader, especially those starting out. So really, we came up with this notion that a better way of documenting and quantifying likely direction and volatility is needed, based on past occurrences of the same market condition. We need a better way of going after this thing. And so last week, we did that using these two things here. We were looking at historical data of the following two items in terms of percentages. Instead of looking at the distribution over 6 different price bands, let's just go straight to how much price changes from close to close, 5, 10, and 15 days in the future. Forget about whether it's hitting bands or not. We're going to deal with the issue of volatility in another way. And last week, last presentation, we addressed it in terms of the average standard deviation of that rate of change. Well, I've subsequently, Brian Johnson, and he's attending here today. Thank you, Brian, for being here. It's awesome. He sent me a fantastic email, and I'm going to go over it today, and we're going to dive into this a little bit, because he suggested that instead of looking at a standard deviation, we normalize volatility based upon historic volatility in a 5, 10, and 15-day manner in terms of it being annualized, so that we could compare it more to the VIX. All right, so we have a kind of a apples-to-apples comparison. Certainly a lot better than comparing standard deviation to VIX. There's really, you'd have to really, there's really no comparison there. So that's what we're going to do today, is show you how we backed into the historic volatility and look at a new version of the market likelihood report, and away we go. So let's start with, where was I here? Yeah, let's start with the rate of change. Let's just review that quick, get that out of the way, and then we'll dive into historic volatility. Okay, so real quick, this is a review. We did this last week. Price rate of change, and I'm using MetaStock here. This is their definition. The price rate of change indicator, and it's the percent method that I'm showing you down here, is calculated by dividing the price change over the last X periods, and we're doing 5, 10, and 15. Dividing the price change by the closing price of the instrument X periods ago. Okay, that's important, X periods ago. The result is the percentage that the instrument's price has changed in the last X periods. And so here's the parameter screen here that you see. You can put any number of time periods, and you can do it either by percentage or actual points. So when you dial it up in MetaStock, what you'll have then is a reading here, price ROC, rate of change, and we're looking at the close compared to the close 5 bars ago, 1, 2, 3, 4, 5, way up here. So clearly the market has gone down quite a bit, close to close, over the course of 5 days, and that's why if you look at this, here we are at minus 1 point something %. That's a rate of change, a 5-day rate of change, close to close, of over a percentage to the downside. So moving forward, though, what we're going to do is we are exploring we are exploring what happens when a certain market condition is repeated in the past, and what is the ensuing rate of change. So what we're going to look at in this case is the notion that this bar occurred, and in this case it was replicating a condition that occurred here about a week ago or so. This occurred back in September of 16. So the same kind of price action that occurred about on April 2nd, I believe, is what it was. And so when that market condition occurred on this bar, we're more interested in what happened in the ensuing days forward. So when we look at the rate of change moving forward, 1, 2, 3, 4, 5, okay, we're going to come down here and we're going to see what the rate of change was for this bar looking backward. See that? And so we can see here that the market definitely went up, okay, a positive level, and this went up a positive 1.37%, as it turns out. I believe that's what it was, if I'm not mistaken. My memory serves. We'll go back and take a look. So the signal occurred here. It duplicated a previous market condition, and just happened. And we're looking at this moving forward, and that's what we want to do. Is we want to know, from our market condition today, what's likely to happen in the future. So when you pencil this out on a spreadsheet, we're looking at the 5-day rate of change and the rate of change percent, and there it is, 1.37 for 9/22, and we're dialing it up we're looking at what the ensuing action was moving forward there. You can see, and this is just how it is. You're comparing this bar to the bar 5 periods ago, 3, 4, 5. There you go. 29.92 is 1.37%. Okay? All right, that's kind of a review. And of course, that's kind of what you're seeing here. I just dialed it up again. We're moving forward looking at this actual rate of change. Okay, let me get a sip of coffee and let's move forward. We're going to look at the volatility aspect of this. All right, it's an interesting thing to say that it's historic volatility when we're looking at the future historic volatility for a given market condition in the past, right? So I thought about calling it actualized volatility. That's a good term. Here at the office, Len Yates likes to use statistical volatility. I'm going to call it historic just for now. I'm open to suggestions on what to actually call it, only because if you go to textbooks and you look at a lot of material out there, they call it HV or historic volatility, but I think we get a picture. It's the actual volatility of the market itself, of the underlying asset itself. It has nothing to do with the option prices. We're looking at the actual volatility of the instrument. I use realized when forward looking. That's a good one. Realized volatility, RV. I like that. Yeah, that makes sense. Makes a lot of sense. Realized volatility. That's excellent. So here's Brian's email here, and I just wanted to kind of go over it, and I might skip around a little bit. It's just excellent. Historical is when you're backward looking. That makes total sense, Brian. So realized is looking forward. Excellent. So Brian sent me this. Steve, I agree that the new analysis is probably easier to grasp for many traders. However, I have a few suggestions. When calculating and reporting realized standard deviations, especially for option trading purposes, I prefer to use a calculation that is consistent with an option model volatility calculations because it uses log returns. Okay? And then there's a paragraph where he describes the process. I'm going to get to that in a bit. Let's go to that right now. And by the way, Brian has a couple books out, and he has a fantastic blog site, traderedge.net, a few services. Just want to give him a shout out for all the help he's giving me on this. Thank you very much, Brian. It's excellent stuff. Here is the process that Brian suggests using to ascertain realized volatility. And it's basically a 5-step process, and I'll just include it here. And I'm not going to read it all, but suffice to say, there's a difference between Brian's methodology and what you're going to find in other material which uses standard deviation. Okay, and this is his process is a resulting proxy for realized standard deviation and can be directly compared across time periods, and this is important, it can be directly compared to the VIX, since the VIX is annualized and it is derived from log returns. Okay, so I took this 5-step process here and I went to a spreadsheet. I ran it all out in my Excel to come up with, on 9/22, we come up with a historic or realized volatility of 9.37. Okay, and when and by the way, in MetaStock, here is the 5-step process duplicated from Brian's methodology here. And one thing that's nice in MetaStock is you can create an indicator, and this is the name of my created indicator, and you can embed custom indicators pretty much within the development of your new custom indicator. So in this case, I'm using these code words over here and referencing them later on. And it's just a fantastic way to build your own indicators. So instead of having to create indicators and reference them all over the place, all in one grand indicator, I'm embedding several others. It's just a fantastic way to go. And what you get then is a realized volatility, and I'm calling it HV just to be, I guess, traditional in that sense. But you get then this line reflecting the volatility level of the actual market. It's fantastic. And so it's a way of measuring volatility. And just to tee off a little bit on what Brian's did the difference is, so the purpose of using the root mean square calculation, and that's what he had in his approach, instead of a true standard deviation of returns, is because it is not appropriate or desirable to calculate the divergence from the mean return. Okay, so when you look at his methodology, that's what he's doing. For example, if we had 5 consecutive days of -5% daily returns, the standard deviation of those daily returns would equal 0, which would hardly be meaningful. Note, this is not a criticism of the standard deviation methodology. It's a criticism of the frequent misuse of standard deviation of market returns, which is even used in, get this, some option textbooks. And you know what? He's absolutely right. I have options textbooks, and they're from big names in the industry, and they're exactly doing what he's saying is not desirable. And let me show, and I'm going to show you some differences between this, the realized volatility from Brian and what the others come up with. What we're doing, of course, is looking forward, right? So we want to know what the realized volatility of this bar moving forward, which is really down here at the 9 level, which I just showed you, I believe, in that previous spreadsheet, right? Yeah, 9.37. And in my MetaStock program, when I went in here and dialed this up, right there was exactly 9.371, actually. So it works out just perfect here. I want to show you, too, the difference between the textbook historic volatility and then Brian Johnson's, and I should put an R here, RV. I'll do that RV thing right. I'll just do that right now just for grins. You know what? Let me get red out. Okay, let me see. We're going to call it RV for realized volatility. I like that. So if you look carefully, you can see that there are some periods here where the two differ by quite a bit. And if you look over here, and most recently in February when we had the market kind of going crazy, Johnson's realized volatility is up at 45 at a time when the textbook volatility was down at 35. quite the difference. Quite the difference. And so other times you'll see they track each other pretty well. Look at right around there or so. So it does make a difference. It absolutely does make a difference. And so that's something to keep in mind here. So what does the new market likelihood report look like? Let's go take a peek. Here we have the market condition as of April 2nd. And I'm pulling this day out because it was just, I was on a timing research webinar here last week, a week ago today. And it was April 2nd when that occurred. A week ago yesterday, excuse me. April 2nd on a Monday. And the market was down in the day. And I ran this analysis. And I'll show you what it came out and looked like. And the question to the panel, and I was on this panel of speakers, and the question to us is, where do you feel the market is going to go over the next 5 days, over the next week, you know, to Friday's close? And the others said, most of the others were very bearish after this breakdown, and it was making new lows. A lot of them were saying, most of them were saying bearish. But let me show you what happened here. So I duplicated the current condition, and I do it in 3 ways. I use 3 dimensions of the market to define the market condition. I look at the 2-bar price action, and in this case we have a downswing bar first. This is a downswing bar that followed an upswing bar. Higher high, higher low, then a lower low and a lower high. Okay, upswing then a downswing. Just a 2-bar price action. Also, this bar here had a true range of over 1%. That's just a 1-day true range of over 1%. So it was a fat bar. So we have price action occurring in the context of trend. Here we're underneath the 50-day simple moving average. And then I look at the stochastic situation, where what range we're in and whether we're trending up or down. And in this case, we were between 10 and 50. And we are actually underneath the 3-day simple moving average or %D. I find that those 3 elements are reasonable. Okay, you can define market condition in several different ways, but I think this 3-dimension look gives us enough population of similar conditions going back that we can have at least a feel for where the market is likely to go, at least to some sort of statistical bias if the future, you know, plays out like the past did. So let's go take a look at the new market likelihood report. And so we're going back to Jan of 2000. We have 4,577 closes of the S&P 500. It's been very bullish during that time. Jan of 2000 to the present, the market's gone up substantially, and on average, from any close to any close, on average, you'll have a gain of about 0.1%. A 10-day change of roughly almost 0.1%, 0.19, and then a 3-week change of 0.29, not quite 1/3. That's on average, a 3-week change of 0.29. So that's the benchmark rate of change. Now, using the Johnson RV realized volatility, we have a 5-day historic volatility of 15.55. The 10-day is 15.93, and the 15-day 3-week is 16.09. Okay, that's just the average realized volatilities over different time frames. Now, let's go take a look at this market condition that occurred 41 times since Jan of 2000. It's a fairly unique market condition because, remember, I threw in that true range of over 1%. That fat bar filter really drops it down to, you know, quite a bit. If I had removed that true range filter, this number would have been much higher. And we would have been contemplating tiny bars even. And so I didn't feel that that was appropriate. The fact we had a big fat bar there, I think, was important in looking at what the true market condition was, and we'll duplicate it in the past. But here's what's interesting. Of these 41, the average 5-day change was 0.6% to the upside. All right. The 10-day rate of change, on average, 0.74. What's interesting is the 3-day rate of change dropped to then 0.32. Isn't that something? Okay, so in light of that, I came back to the panel and said, hey, here are the statistics I'm looking at. And I get it, but breaking new lows and all that. However, looking at these statistics here, I'd be, and I showed it to them, and I showed them that, and I weighed in on the bullish side with a kind of a low percentage of certainty, but that's okay. The 5-day realized volatility, 21.25, substantially more than the baseline realized volatility. Then it about holds the same for the 10-day, and then the 15-day, very, very close to each other moving forward. Okay, all three, though, are much higher than the benchmark realized volatility levels. Okay, now what I like to do is I break it out in terms of price exceeding the previous day's high or low. There were 6 times where it broke through and popped over the previous day's high. So in this case, I said that if the next day it pops over here, what's our price distribution from the close here if we penetrate the high? Okay, now that occurred 6 times, and we see a gain of 1.3, 2.1%, and 2.22%, substantially bullish. And then the realized volatility is actually much less because we're going to the bullish side, and usually the volatility of the market is lower on the bullish side than the bearish. Now, on the downside, interesting, of the 33 times in the past where market broke through the low of that big down bar, the 5-day change was still a positive 0.39, 10-day was positive 0.54, and the 15-day change was pretty much flat. Okay, so so it was flat. The volatility, though, was much higher than if the market had gone up and penetrated the high, and obviously quite a bit higher than the benchmark that you see there. One aspect I wanted to point out, too, is on the close of that day, we had 9-day VIX. The short-term VIX was at 27.31. The normal VIX, the 30-day VIX, was at 23.62. Both numbers are substantially higher. Certainly substantially higher than the one if it penetrated the high. But look at this, though. I mean, the short-term VIX is a little bit higher than the shorter-term realized volatilities that we see here. This is another avenue of research for me to compare these realized volatilities to the VIX as it was back then, and maybe do some overvalued studies in over and undervalued options, and maybe recast that study in the light of using calculated realized volatilities. What happened in that case? And this is just anecdotal, of course. This is just anecdotal, but in this case, after I weighed in on the bullish side, of course, the market then proceeded to go up, and here we are, today, here on the 10th. This was earlier in the morning today. So I felt pretty good about that. Just interesting, taking the market condition in the past and casting it in this way. I could actually see the measurement, and I didn't have price distribution bands to mess with or any of that. I could actually see that number right here on the, these numbers, I think, just brought it home. Hey, you know what? There's something to this. Now, Brian brings up another point regarding Z statistics. I'm going to look at that more and perhaps incorporate that into these studies as well. It's all good stuff. All right. Anyone have questions, comments, Brian? Okay. Awesome. Brian, thanks again for your contributions to this. Much appreciated. Folks, thanks for joining us today. We'll talk to you later. Take care. Bye-bye.